the moment we have up to a dozen transactions that are anywhere along the process, from first negotiations before heads of terms through to getting the stock transfer form stamped at the end of the process. So there is a lot of work buying and selling businesses. We currently see deal sizes around £300,000 to £20 million, but we have, even this year, completed a transaction where the purchase price was only £5,000 because it was a strategic acquisition, and also worked on a purchase of over £50 million. So there is quite a broad range. So all my years of practice, what's my top tips, top takeaways? First of all, it is a process. It's not as easy as it might be. I'm sure 200 years ago, a blacksmith could sell his forge on a handshake and walk away. Nowadays, it tends to be quite a lot more work. And the next two tips probably become part of that. So buyers, bear in mind that the seller has built up the business themselves. It's their baby to a certain extent. So anything that they don't like about your investigation is probably related to that. And the flip side of that is sellers don't take it personally. A buyer has to get a full picture of what they're buying. It's a process, and they will ask more questions than you thought was possible, but it will get through that process, and it's just part of getting this complete picture.
Okay, so what I'm going to talk about first is things that you should consider before selling your business. So this is obviously from the seller's perspective. As Helen often says, this can be a painful process, and it is a process. I know Helen often describes it as like selling your house, but 10 times worse. And I just sold a very small flat. I know that was incredibly painful, so it sort of puts it into some perspective. So the things I'm going to talk about now are hopefully ways in which you can maybe alleviate some of that pain, or maybe I should say front load it a bit and sort of get it out of the way before you get into the serious negotiation of a sale process. So the first thing to think about is, why do you want to sell your business? And as a seller, you might think, it's really obvious, that it may be very clear to you seemingly, but it's worthwhile to, just before you move into a full sale, to step back and think about what you're trying to achieve and the reasons why you're trying to achieve it. It will allow you to focus your attention on the things that matter, and probably more importantly, you can tell your advisors what you want them to focus their attention on. So the following are sort of some typical reasons why someone might be looking to sell a business, and in reality it's probably going to be a combination of a few of these things. One being retirement. It may be that you've worked a long time in a business that you've grown, you're later on in your life and looking to secure your financial future, and then your motivation is likely to be getting a sufficient payout that allows you to be secure and for your family to be secure. And it may be in that situation that you're happy to sort of stay in the business for a while to do a handover period because you're not in a rush, but you do want that break when you can sort of say, okay, I'm done with my working life now. This is yours to run with. The next is health reasons. It may be that for reasons of ill health, you're unable to devote the time and attention and effort that you've previously put into running a business, and so you need to cash out to pass it over to someone else who can do so, and hopefully you can again secure your future. And here there may be a slightly more focus on getting out sooner rather than later, having less of a handover period. It may just be that you want to do something different. You may have had another opportunity come up that's time sensitive and you need funds to be able to pursue. It may be that you're an entrepreneur who feels that your efforts are best suited to an early stage business. You're great at coming up with the ideas, and you're great at, maybe it's a technical business or a creative business, and that's where your talents are best suited. But as a business grows, you may have become more involved in management of the company, and you may feel that that's just not the best use for your skills, and so you may wish to sell your business and then take up another opportunity where you can better use your skills. It may be that you feel that you have grown your business as much as you can. You may feel like it's plateaued, and it may take someone with a greater network, maybe, I hesitate to use sort of management speak like synergies, but it may be that those sorts of things can help the business grow, and they're just you've taken it as far as you possibly can, so you want to realize the profit in what you've built and then pass it on to someone else who can grow it further. And in that sort of situation, and Helen will talk about this later, It may be that you want to retain some sort of interest in the business going forward so you can see that upside as opposed to just cashing out. Although where you may want to cash out is where you think the business has peaked. So it may be that the sector you're working in, you feel like you really know it and you foresee issues coming around the corner. You don't think that you're going to grow profits much beyond where they are. And so you think that the business is worth as much as it's ever going to be. And so you think now's the right time to sell. There may be slightly more time pressure, and you may want to be sure that the amount you're paid isn't necessarily tied to the future success of the business as much as with the scenario I just discussed. And finally, it may be that you weren't actively looking to sell, but an offer just came in that was too good to turn down. And there, obviously, you're going to have a stronger negotiating position potentially, and it's all going to be about getting the right deal to mean that you really can't turn it down and you take an offer you weren't otherwise looking for. The next thing to consider is, what do you want to sell? So the two primary ways in which we see businesses sold are share sales and asset sales. So I'm sure a lot of people will be very familiar with this, but just a whistle-stop tour through the differences. A share sale is where you sell the entire business. It's sort of the traditional view of what mergers and acquisitions are. It's where the company changes hands from the sellers to the buyers. The transaction takes place between the buyer and the shareholders, and the company moves from one to the other. The buyer essentially steps into the shoes of the sellers. And it's important to remember that this is a transaction between the buyer and the sellers, and so it's the sellers that will be paying tax on the consideration they receive for the business, and they'll be paying capital gains tax, and they may be able to make use of what's now called business asset disposal relief, previously entrepreneurs relief, which lowers the rate of tax they pay from 20% down to 10%, and there's a £1 million lifetime limit on that at the moment and for the foreseeable future, we think. And so you can hopefully utilise that if you haven't done so already. And the next is an asset sale. This is where a buyer buys the assets of a business, and we refer to it as the transfer of the business as a going concern. So what that means essentially is that the buyer takes enough of the assets of the business that they can carry on running it in the same way as it was run before the sale. And they're able to cherry pick assets, which means that they can take what they want and leave behind the liabilities. And this is a deal between the buyer and the company, because it's the company that's selling those assets. And so the sellers will be left in the end with the business still, with the company, I should say, still there, but with just maybe a very few number of assets or none at all, and the liabilities. And the company will have to pay corporation tax on the receipt from the sale. And then there's also going to be a tax liability for the shareholders of the company when they look to extract that cash, so either by way of dividends or by winding up the company. And for this reason, we primarily see share sales, the main driver behind that being the preferential tax treatment for sellers. And so for that reason, we're going to talk in this webinar primarily about share sales, but a lot of what we say will be equally applicable to asset sales, or that a lot of the key documentation is very similar. But if you have any questions about how something we've said might apply differently to an asset sale, there's a question and answer function. Please, if it's for any question throughout the webinar, please feel free to just put your questions in there. We'll see if we can deal with some of them as we go along, or if not, at the end, we'll come back and try and deal with all of your questions. And as we say, they're more common. We see asset sales, and often we might see a buyer pushing for an asset sale early, but the seller's keen to sort of move it towards a share sale for their better tax treatment. The next thing to consider, and obviously a very important thing to consider, is how much do you want to sell your business for? And this is going to be driven in part by your motivation to sell. So if your motivation is purely financial, this will be the single most important factor. For example, if it was on retirement, or just having received an offer that is financially so favorable, you feel you can't turn it down, then you're going to really focus in primarily on this. If your motivation is slightly different, say ill health, or you're looking to take advantage of a time pressured opportunity, then it may be that you're willing to compromise slightly on price in order to negotiate other terms, like the ones I referred to earlier about seeing upside further down the line, or the length of time you remain engaged with the business. If you're planning on actively marketing a business, it's a good idea to try and get it valued beforehand. One, so that you have better justification to a buyer when you're trying to pitch them a price, and two, so you have an understanding and an expectation of what you can reasonably get for your business. I'm going to quickly run through a few typical types of valuation. and different ways you can value your business. The first being a fairly simple asset valuation. So essentially you take the assets of the business and you say which each one is worth, and the total of that amount is what the business is worth. And this is most appropriate for sort of maybe a bricks and mortar a property development business, for example, where the assets form the majority of the value of the company. The next is a multiple of earnings, for example, EBITDA, so earnings before interest, tax, depreciation and amortization. But there's other measures you could use as well. And usually you apply a multiple to an earnings figure to come out at a value. And there tend to be industry multiples that valuers will be able to advise you on, and some people on this call I'm sure will be able to advise you on, webinar. And it tends to be the sort of early stage tech businesses will have very high multiples, whereas long established bricks and mortar businesses are likely to have lower multiples. So it's where if the expectation of growth of a business is higher, you can apply a higher multiple to the current earnings. The next is an entry cost valuation, which is essentially an estimate of how much it would cost to set up a competing business similar to the one being sold. And then that's how you get to the value of the business. Next, a discounted cash flow. This looks at the amount of money that a business churns out, primarily by way of dividends for its owners, and then applies a discount for the risk of those dividends continuing to be paid for a period of time following completion, usually a period of around 15 years. And sort of typical discounts are around 15%, but again, it depends on sector and risk factors. And then finally, what's referred to as comparables, which sort of going back to the house sale analogy is similar to that. It's where, in the same way as when you're valuing a house, you want to look at down the road and see which similar houses sold for how much recently. You try and look at similar businesses sold recently and see how much they were valued at, or sold for, I should say, and that's how you come to the value of a business.
Yeah, and of course, the best way to get your price up is to have more than one person interested in your business. So if you can get any sort of a bidding war going, that's always a true reflection of what somebody else thinks your business is worth. Yeah. So in terms of when you want to be paid, obviously, if you're a seller, you would like to be paid on the date of completion and walk off into the sunset with your cocktail. If you're a buyer, you might think that you would like a bit more hedging around that risk, and that's where the sort of discussions around earn-out come in. That can also be because the buyer obviously needs to find the money to pay the rest of the purchase price, but it's typically because the buyer wants to see what they're actually buying and how well it performs. And an analogy for football fans is that you would pay a certain price for a football player, but there will be add-ons depending on how many matches they actually appear in. So in our sales, we typically see up to a 60-40 split. I would say most cases you get more upfront than you do in your earn-out, and if you're not getting that, it may give you sort of cause for concern. And in terms of the length of time of the earn-out, which I will talk about on a later slide, we typically see up to around 3 years.
Okay, so now we're going to look at converting initial interest into offers. So it may be that you've started to market a business, or your advisors have been doing that on your behalf. And it seems like you're sort of getting a few bites on the hook, but you really want to know how you reel them in and turn them into proper offers. So the first thing to do is prepare up-to-date accounts. It will seem obvious, but a buyer wants confidence in the financial position of the company, and the more recent the accounts are, the more likely you are to be able to convince them, one, of the value of the company, and also sort of that you are attuned to the financial concerns of the business, that it's been well run, that you have your finger on the pulse, and ultimately they will often be buying into the sellers as much as anything else, buying into the idea that these sellers have built something worthwhile. And at this stage, they won't have sort of looked under the hood too much in terms of their due diligence. So this might give them their sort of first impression of how well the business is run. And a first impression can really last, so it's good to make as positive one as you can. The next is to tidy up any issues that might come out anyway during due diligence. So the buyer is taking on all of the risk as sort of the starting point. The legal principle is caveat emptor, to sort of throw in some Latin to make it seem like I really am a lawyer. Which means buyer beware, that the buyer takes on all the risk, and then the share purchase agreement sort of tries to reallocate that risk, and it's sort of the purpose of it, which Helen will talk about later, is for the buyer to try and reduce some of their risk and pass some of it back to the seller. But they're going to be doing due diligence to reduce this risk and trying to find any issues they can with the company. And they're going to be paying advisors lots of money to try and find issues. And so they're going to want to prove their worth. And so they'll be very keen to at least have something to report back on. So you want to try and clear up as many of these issues as you can before it comes to, before you allow the buyer to find them themselves. So some of these might be contractual issues. You may have run your business fairly informally if it's grown, or if you've been running it from day one. And it may be that certain things were done on a handshake or just a mutual understanding. So it's worth trying to put those into writing, have signed up agreements that you can show to a buyer to evidence how the business is run. You might have a lease might be really essential to the business. The premises might be, retaining use of a premises after completion might be something you need to consider. With contracts and leases, they might contain change of control clauses, which might give a counterparty the right to terminate an arrangement upon the transfer of the company. So what would happen during a sale? So you want to be sure that you've, at the very least, you know of those risks and can advise a buyer of them so that they can look into it as early as possible, or potentially you can renegotiate those deals so that, they have to act reasonably, let's say, or there's, if there's a buyer who has a greater covenant strength, so let's say deeper pockets, so it's something that they shouldn't be a lessor shouldn't be worried about anyway, then they won't exercise that change of control provision. And then the next is minor disputes. If there are any, let's say, outstanding invoices or disputed invoices, small things of that nature that can just be cleared up before it comes to a buyer, putting together a massive long list of things that they're worried about and may want protection against in the share purchase agreement. It's a good idea to get ahead of the game and try and sort those out as soon as possible. And then a final one is statutory registers and filings at Companies House. It seems boring and it seems simple, but it can be an incredibly labor-intensive process if, in particular, the register of members is out of date for a company. It would need, I won't bore you with the details, but you might need to reconstitute the statutory books, and it can take a long time. And it's not time that you're going to want your advisors spending during negotiation of a sale. So it's good to just get everything in order before you actually head further down that road. The next thing is reducing dependence on the owners. So with an owner-managed business, it's likely that the sellers are responsible for the success of the company. It's their hard work and the information contained within their brains that is key to the business being in a position to be sold. And so you're going to want to try and reduce that dependence so that a buyer won't be worried that when they take over the business, when they potentially, maybe immediately or at least within a number of years, lose that benefit, that the business will be able to carry on being profitable. And so ways of doing that are, one, delegating, so finding people who will be remaining in the business long term, who can take over some of those responsibilities, and then also just sort of trying to download information that is often just stored in one individual's head, and at the very least, putting it in a Word document or having an information repository where the business can go after a seller leaves and say, this is where the answer to that question lies, and the business can carry on functioning without having to call up that seller and beg them for a favor every few months.
Yeah, so I mean, part of that is if the sort of the problem that you found when you're tidying up the business is so significant, you might actually want to consider some sort of a reconstruction. Spinning off toxic assets is not just for RBS. Smaller companies might also wish to move some of those sort of areas that aren't really pushing up the value of the business into a new entity or selling those separately, and really thinking about putting together a clean bill of health for the company that you're really trying to sell. In terms of the timing, you might want to undertake that reconstruction sooner rather than later if you want to achieve a tax neutral spin out of some part of the business. So it's really worth looking at what the problem areas might be as early as possible and spinning those out. In terms of the tax structuring, Joe's talked about the asset sale versus the share sale point. And when you look at the business, it may be that you actually, depending on what you want to do with the proceeds going forward, you might think that actually an asset sale works for some reason. So it's thinking about that from your personal point of view. If you're planning to reinvest the funds immediately, then you might want to undertake an asset sale, and that means you don't have to undertake this spin out of the toxic assets. But more usually, you would want to be thinking about the sale of shares and how that's all going to be structured. You need to think about who holds those shares, what percentage of shares have they got. Just very briefly touching on the conditions for business asset disposal relief, which is the 10% tax rate for capital gains tax. You need to own 5% of the shares with a 5% right to dividends and voting. So it's a case of looking at your share structure. Is that going to work? Have some of the shares been given to a spouse and that spouse doesn't work in the business? Do you need to look at how those shares are all held? And that's part of the early stage planning. The next point, in engaging professional advisors, I'm sure most lawyers would say as early as possible. We tend to say we're here in the background, but until there's a lawyer engaged by the other side, you may be as well to continue your discussions on a buyer to seller basis without involving any advisors. It's all a sort of a question of degree. I would say that the key upside to having an advisor on board is you can blame them. So we are here to play bad cop, and every decision that the buyer or the seller, the person on the other side doesn't like, can be squarely blamed on the advisor, whether it's a broker, accountant or lawyer. The next slide is to talk about how to choose between these different offers. There's the upfront or deferred consideration point that we've talked about. There is also a third element of consideration, which is called the retention, which isn't usually considered either upfront or deferred consideration. It's when there's a known risk in the business. For example, there's a rent deposit deed and the buyer has every expectation that that rent deposit deed is going to be returned, and so does the seller. But in the meantime, a pot of money and part of the purchase price will be held back for that retention. Otherwise, there's the usual split is between upfront and deferred consideration. We've talked about the difference between the sort of the range of percentages that you can see there. Why would the buyer be more keen? They often want to keep the seller involved in the business as an employee for a handover period, and they will tie the deferred consideration to the length of time they might want to keep the buyer in the business. It's important to be clear that no part of the consideration is tied to that seller remaining in the business, however, because that can have an impact on the tax treatment of that purchase price. So that's something to flag there. The length of the earnout, it's worth asking the buyer, why have they suggested a 3-year, 4-year earnout? What's their justification? It may be that they're trying to find the money, or it may be that they somehow see the business as tied to a certain length of time, a cycle of client renewal or otherwise. You may be offered cash, or part of the purchase price could be some shares in the person who's buying you. To the extent it's shares, you just have to, again, be careful of the tax position. It can be tax neutral. You need to think about, if you do have to pay the tax, you'd be paying tax on shares that you just hold the shares. You will see a future purchase price if the person who buys you goes on to sell. But obviously it's bearing in mind that at this point you go from being a majority shareholder to a minority shareholder, and how that works from your point of view, what protections you're going to want. Obviously it's looking at whether the buyer wants you to remain as an employee, and that can be both positive and negative. So if you're somebody who wants to stay as an employee in order to protect the earnout, then that can be one of your considerations, versus if you really want to head off into that sunset, whether that's really a key consideration for the buyer. You may have a discussion at heads of terms stage about the liability caps. It varies. I'd say usually you wouldn't have a long discussion around it there, but if it's very important to a party, that can be part of something you think about before you've chosen your offer.
And liability caps sort of a key to that. walking off into the sunset idea, because it may not really feel like you've sold your business until the money is in your pocket or bank account, but that you know it's going to stay there. And both the time and financial limits are going to be key to that. Especially if you're looking to sort of take advantage of an opportunity similar to what Helen spoke about previously. There's an opportunity, and it may, you want the money in your pocket ready to go to take advantage of it. You may not feel comfortable spending it if you are concerned that there may be a liability still outstanding, a claim against you by the buyer. And we should say that claims under an SPA are rare, but it's all about comfort for a seller, really. It's knowing that the money is secure and finally theirs, and theirs to do with as they wish. In terms of the time limit on liability caps, sort of what we see typically is 2 years for most claims, and then 7 years in relation to claims that relate to tax. The reason for that 7-year period for tax is because HMRC have 4 years ordinarily to make a tax assessment, but that's extended up to 6 years for any sort of any sort of error that is caused by careless inaccuracy. So if from the buyer's perspective, you would be saying, well, HMRC potentially have 6 years to begin an assessment. I then need enough time after that assessment has taken place to assess a claim and potentially bring a claim against the sellers. And then, it's really into how long is a piece of string in terms of claims for non-tax reasons. But it's a negotiation point. 2 years is typical. You can see it as low as 12 months, and you can see it as much as 3 or 4 years. But it's all about negotiation, and it may it's something that needs to be considered holistically. It may be that you're willing to accept a slightly lower financial limit or higher financial limit, depending on how you agree a time limit. And on to financial limits, on UK transactions, we tend to see the limit on the liability on claims being either the whole of the purchase price or sort of down to 80% of the purchase price. What's really important from a seller's perspective is to make sure you're only ever liable for funds you've actually been paid. So if there's a deferred element to the consideration, what you don't want is to have only received part of the total purchase price, but for there to be the potential for you to be sued for the whole of the purchase price, meaning you'd actually be out of pocket from where you started. In cross-border deals, especially where there's a US element, they tend to have much lower financial liability caps, or between 40 and 60%. But that's sort of the only way in which their deals tend to be more seller-friendly. Everything else is incredibly buyer-focused. So there's give and take in all these things, but 80 to 100% is what we see typically in the market. There'll also usually be a de minimis threshold for claims, which sort of tries to avoid the death by 1,000 cut situation, which sort of tries to avoid a buyer being able to make lots of small claims for lots of little things that add up to one big claim. Typically, a buyer won't be allowed to bring a claim for more than about 1% of the purchase price. Again, that it's a movable feast, but that's sort of a typical market position. And there is a way that you can try and alleviate some of these concerns, which can be concerns for the buyer and the seller of being able to recover money under a claim, and that's to take out a warranty and indemnity insurance policy, where an insurer will be paid an upfront cash amount, usually on completion of the share purchase, which will mean that they will underwrite any claims that are made for breach of a warranty or an indemnity claim, which Helen will go on to talk about a bit later. But essentially what that means is that a seller can walk away knowing that it's not going to be their responsibility to stump up for any claims, so the money is theirs. And the buyer has a bit more comfort because they know that there will be a large institution with deep pockets who they can go after if they need to make a claim, and they won't have to rely on a seller having the money to be able to repay them. And also that avoids the need for retention potentially, because again, everyone knows the money is there, and there's someone with deep enough pockets to ask it. So I've just seen a question come in. So yeah, we've had a question from Alex Kennedy asking, do we often have a situation where a share sale turns into an asset sale to deal with issues identified during due diligence, and how common are asset sales compared to share sales? So yeah, I think it's worth dealing with now. Yeah, I mean, Helen has more experience than me.
Yeah, I would say that it's rare that it would change direction like that, simply because the tax position is usually so great, and because most people will treat it the other way. They will spin the toxic asset out of the existing business rather than sell the assets partway through. So I would have to say it's quite rare to change direction midway through, and usually there's been a discussion quite early on about the process rather than later on.
Yeah, and I think I'm going to come on and talk about sort of where things can go wrong and sort of how those can be dealt with, but a more likely resolution to an issue being identified during due diligence is for a buyer to ask for indemnity protection. So we'll come on to this, but it's essentially where they say, here's our liability if this comes to pass and the business I'm getting is worth less than what I expected, I expect to be reimbursed on a pound for pound basis to take account for that. Then in terms of how common asset sales are compared to share sales, I'd say maybe, in my career, maybe 5 to 10% of the deals I've worked on have been asset sales.
Yeah, I'd agree. It's definitely less popular, simply because the asset sale involves moving every single asset. So it's the moving the employees, it's the unsettling of employees, it's the assigning the contracts with suppliers and customers, and usually it's sort of not wanting to have that discussion, which allows a customer to reopen their pricing structure. The customer typically knows nothing about it. One person owns the shares on Monday, someone else owns the shares on Tuesday. It doesn't impact on that at all. So it's much smoother transition process if it's a share sale.
Yeah. Okay. Great. I hope that answers the question, but any more, please do keep them coming. The next thing that may be a factor in choosing between two competing offers is the level of commitment of a buyer. Sellers will be keen to avoid a buyer. The fear is that a potential buyer is actually just trying to gain confidential information about the company. It may be that you're selling your business through an auction sale, in which case the risk is slightly heightened, because you could have multiple parties just trying to sort of get past a first round where they're all given a suite of information about the company to allow them to make bids. And so, or it may be that just a competitor is looking to take over a company, and you're very conscious that if the deal doesn't complete, they may get information which would allow them to have a competitive advantage over the target business. And there are a number of ways to try and alleviate these concerns, chief among which I'd say is having a buyer pay a deposit. And it will be a subject for negotiation, the extent to which that's refundable or not, or part refundable, part not. But seeing money actually on the table is likely to give sellers a bit more comfort that a buyer is really committed. And in a similar way, having a buyer engage their professional advisors early on and rack up fees with them, not just doing due diligence and not just trying to uncover information about the company, but engaging with the sale process, providing return a draft of the share purchase agreement, and engaging more widely in handover mechanisms that time that's being spent and money that's being spent on things that they aren't just to try and extract information about a company. And then the final one is trust. I say final, there'll be more than just what's on the slide, of course, but a big one is trust. It's essential in selling a company or doing any deal. You can try and plan ahead, and we're trying to sort of give you tips and tricks about how you can plan ahead and alleviate pain, but don't be under any illusion that the buyer and seller have conflicting interests, and something is going to come up during the course of a transaction that is going to need negotiation and resolution, and maybe sort of slightly fractious at times. And the more that you can trust that a buyer is going to sort of stick to the spirit of a deal, rather than necessarily trying to sort of hang their hat only on what's in writing and agreed, the more likely a seller is to feel comfortable. And it's just crucial to know that a potential buyer is committed to a deal and you can trust them. Okay, so the next thing we're going to discuss is heads of terms, and you might have heard of these referred to as any weird and wonderful number of things: a term sheet, a memorandum of understanding, a heads of agreement, a letter of interest or a letter of intent. All essentially mean the same thing. It's a document entered into between a buyer and a seller that sets out the key terms of a transaction. And the heads of terms are likely to include things such as the parties to the transaction, which may often seem obvious, but it's often, there may be a parent company that's buying it, or there may be a newly incorporated company that's used to buy assets, particularly if it's an asset sale. And so it's important to drill down on who that is. The purchase price, the structure of the deal, a rough timetable for the deal, conditions that the deal is subject to, who's responsible for certain procedure and drafting responsibilities. So who's going to provide the first draft of the share purchase agreement, for example, and then exclusivity and confidentiality. And sort of focusing in on the purchase price that's going to be included, it's really important to understand the difference between the enterprise value and the equity value of the company. In broad terms, the enterprise value is sort of a headline figure that's calculated by one of the valuation methods I referred to earlier, whereas the equity value is the amount of money that's going to end up being paid to the sellers for the business at the end of the transaction, or at completion, or sort of if there's a deferred element later. And the difference occurs due to adjustments that are made to the enterprise value to account for things such as cash in the business, any debts the business may have, and the need to retain working capital to allow the business to carry on trading after completion. And so a common phrase that a lot of you might be familiar with is that a deal is done on a cash-free, debt-free basis. And what this essentially means is that a seller is expected to pay off all of the company's debts and extract all of the company's cash prior to completion. But in practice, what it really means is that the purchase price is going to be reduced by an amount of the debt and increased by an amount of the cash. So the enterprise values of your starting point can be adjusted up or down. There'll also be an adjustment for working capital. So the buyer's going to want to know that when they take over the business, if a bill comes in the next day, and sort of a bill that occurs in the ordinary course of business, so for example, payments under release or payments to a regular supplier, they're going to have enough money in the business to carry on running it as the sellers had run it prior to completion. And a target level of working capital will be agreed, and it's often a key point of negotiation. And if there's and depending on whether that working capital target is hit, or sort of whether there's an excess or a deficit, then the purchase price will be adjusted either way. And so sort of set out as an equation, if sort of any of you are more mathematically minded than I am, the equity value is equal to the enterprise value plus the cash minus the debt plus or minus the working capital adjustment. And I'll talk about this maybe a bit later on, but what's really important is that sellers don't get lured in by a high enterprise value, which is sort of made to be artificially high, which is then reduced down by those adjustments we've discussed, and so they don't end up getting the money they expected. And I'll talk about that when I speak later about what can go wrong in a deal. So heads of terms are always referred to as not being legally binding. The asterisk there is to refer to the fact that there will be a couple of provisions that are legally binding, in particular the exclusivity, the transaction costs, and the governing law. So transaction costs being usually that the buyer and seller are each responsible for the cost of their own advisors. But they are what we refer to as morally binding. And many of you may be thinking that the idea of lawyers being governed by a very strict moral code is slightly fanciful, but I mean, we hope it's not, and we think it's not. But when lawyers talk about something being morally binding, that tends to have a lot of force. So essentially what that means is that the heads of terms evidence what's been agreed between the parties, and those terms won't be derogated from unless there's a compelling reason to do so. So that's why you really have to be careful when you are negotiating heads of terms, that you don't put something in there that you think you're going to negotiate later. And obviously, you know, the more detail that go into your heads of terms, the more time you're going to save. This will save both your time in negotiating things between buyers and sellers, but it will also save time of advisors because they will know what your position is. They won't have to keep coming back and asking you, and they'll have that sort of one-stop shop. You know, if there's a well-drafted heads of terms, I know that I am constantly referring back to it when I'm drafting documents, when I'm reviewing drafts of documents, to make sure that these reflect what the agreed position is between the parties. And it's really helpful. It saves time for everyone, and probably more importantly, saves money because advisors aren't having to rack up fees in going over ground that you think has already been covered. And sort of the warning point just at the bottom of the slide is don't agree points that you think you're going to negotiate later. It can be tempting to want to get past the heads of terms stage, because that's when a buyer will feel committed, a buyer will have more comfort because they'll be given exclusivity. And so you may think, oh, I'll just let this slide in the heads of terms and we can come back to that later. but it sort of goes back to that morally binding point that something in the heads of terms is expected to end up in the final transaction. And if you're going to want something to change from the heads of terms, there's probably going to have to be a quid pro quo. You're probably going to have to give something back to get that concession. So take your time at the heads of terms, engage professional advisors if you think that would be helpful, but make sure that nothing goes in there that you already know is not going to be the agreement going forward.
And then there's the share purchase agreement. Most people are quite shocked when they see it. It's usually heading towards hundreds of pages. But I think the important thing, the way to sort of address it is to come back to what's the key purpose of the share purchase agreement. And it's this principle of buyer beware. So the purchaser is trying to find out everything about the business. So what they will do is prepare a document that has statements about every element that might apply to the business. And those are called the warranties. And to the extent that any of those warranties aren't accurate, the buyer will want to know that they're not accurate. And the seller's process of explaining that to the buyer is to put together what's called a disclosure letter. So part of this is also all tied into the due diligence. So it does, to a certain extent, it's a bookend, the due diligence process at the beginning and the disclosure process at the end. So the best practice is to tie those together by using the same documents. And this is where actually indexing is your friend. It used to be that there was a physical data room in a company where the company put all their books, and people, usually very junior lawyers, would go and trawl through them and write a report. Now, fortunately, they are online data rooms. But then part of the key discussion can be how much of that online data room is considered disclosed, how much of it has the buyer actually seen. And part and parcel of the discussion around the share purchase agreement, looking at the warranties, which are the statements about the employees, about the pensions of the business, the IP, the contracts, every detail that the buyer can think of is thinking about, well, how do I disclose against that? What information have I provided that allows the buyer to know what they're buying, but also protects me as the seller, so the buyer can't turn around and say, there's a risk in the business. You gave a statement that X applied, and that's not true. Therefore, I'm making a claim against you for breach of contract because the warranty was not correct. Just to use an example of, say, an employee claim. So Joe Bloggs brought an employment claim against the company 6 months ago. There's a warranty in the share purchase agreement that says there are no employment claims against the company. So the seller says in the disclosure letter, Joe Bloggs sent us this letter on this date, therefore it's disclosed, and the buyer can't then turn around and say, this has happened, I want to reduce my purchase price. What they may do, unfortunately, is put it in as an indemnity. They might say, well, there's a risk, we know about it, that impacts on we're paying. If Joe Bloggs is successful in his employment tribunal complaint, we will reduce the purchase price accordingly. But the key in all of it is to have an organized data room, put it together and understand that the data that you're providing stands behind the warranties that you're giving. Joe's mentioned that there's warranty insurance, which can be a way of dealing with it, but there is no substitute for basically going through line by line those pages and pages of warranties and checking which ones are accurate.
Yeah, and warranty indemnity insurers, even if they are providing insurance, will insist that you've done a full disclosure process, because obviously what they're concerned about is you just knowing that they're the ones who are going to be picking up the bill, and just sort of not looking to reduce your liability because you're not, it's not coming out of your pocket. And so they will insist on being involved in every stage of the disclosure process. And that's why maybe I should have mentioned they can add sort of up to 20% to transaction costs, because they have to be so involved to know that they are not going to be taking on liability that you have just sort of been willing to offer because you're not the one standing behind it.
Yeah, so that's where indemnities are more like insurance, in fact, than the warranties, so an indemnity is if an event happens. So using the Joe Bloggs example, that there's a risk that's out there. If that happens, the seller has to pay on a pound for pound basis. So sellers like indemnities, buyers like warranties. And that's just, we could go on for hours about those, but I'm aware we're running out of time slightly. So just to talk about earnouts and tax treatment, and why that's important in most of the transactions we deal with is coming back to this the capital gains tax relief, BADR. So essentially, because one of the conditions is you're an employee and another one is you own the shares. That means that you may want to crystallize your entire gain at the point of completion. Of course, that's slightly tricky if you've got an earnout element that is tied to profits or is tied to the number of clients that the business retains. So therefore, it's a question of working out how the earnouts should be valued so that you're paying the appropriate tax at the right time. So that then is a longer slide about earnouts. We've talked about the reasons for the buyer wanting to keep the seller engaged, also the buyer getting the funds together to pay it out. It is one of the biggest areas of dispute. It's very common that there will be a different way of saying how well the business has done a year down the line. Obviously, when everyone's sort of working towards completion, working late nights, they're all in agreement about this is all going to be fine, we will pay out the earnout. A year or two down the line, there might be a different person who's dealing with it as the buyer, and they're tasked with being absolutely accurate on every detail about the various schedules. Of course, if the earnout is tied to profit, that can be one of the biggest areas of dispute, because as everyone who owns a business will know, how profits determined can be very up and down and tied to what the company is spending. So it's important in the share purchase agreement that you've talked about restrictions during the earnout period. What can the buyer do? Can they charge management charges if they're part of a bigger group? Can they change the direction of the business? Can they sell some material assets? Which employees do they have to keep on board? Sorry, I see we've got another question. So
right, should we whistle through and then come back, or let's have a look? Is the BADR, sorry, question from Max Francis, is the BADR limit on the relief or on the gain? Can't find a decent example on HMRC's website. Sorry, on their behalf.
It's on the gain. So essentially, if you sold your business for £1.5 million, your first million, and we're not talking about an annual relief, which is also there, which is 12,300 at the moment, but let's just assume you've used that to sell a painting otherwise. So it's the capital gain you've made in your business is 1.5 million. So the first million would be subject to the 10% CGT, and then the next 500,000 would be subject to currently 20% CGT.
Okay, I'm now going to quickly try and just whistle through, sorry, if we can just get the next slide. Why deals go wrong. Sorry, I have got an eye on the time, and I know that we want to have more time for questions at the end. So I'll quickly run through these. Price adjustments, I referred to this earlier, but what the concern of a seller might, or the reason why this might go wrong, is because a buyer looking to get exclusivity may have put in their offer a high enterprise value, a high headline price, that they then seek to reduce down during the course of the transaction by way of negotiation of, for example, a high working capital target, safe in the knowledge that the company won't achieve that and they'll be able to reduce the amount they actually pay. And so, you know, it's easy for a deal to go wrong in that way. And it's really important to, one, understand what gets you from your headline figure to the amount that's going to end up in the seller's pockets. And two, to try and get as much of that negotiated upfront as possible at heads of term stage or early on in the transaction, so that it doesn't derail a transaction once everyone's a bit more committed and has already spent money getting further down the line. The next, and sort of Helen touched on this, is issues that come up during due diligence and disclosure. So the buyer is going to find out things that they previously didn't know, you know, however upfront the seller is. But it's all about the seller being as upfront as they possibly can be to reduce these issues. You know, a small issue isn't going to derail a deal, but if there's a large liability for a claim against the company that the sellers know about, you know, tell the buyer as soon as possible, because, you know, rest assured they will find out themselves anyway. There's no point trying to hide anything, because it will come out, and even if it doesn't come out immediately, you're going to have it in the back of your mind that it might, and so, you know, you're never going to feel comfortable that you're going to hold on to what you've been paid. So tell the buyer early, and hopefully that can reduce it. And, you know, there are ways around these issues we spoke about, you know, indemnity protection, warranty indemnity insurance, and from a seller's perspective, the more a buyer knows, the less they are able to claim for down the line. So telling them as much as possible, as early as possible, is always the best way to go. The next is delay, and delay can be a cause for a deal to fall over in and of itself. And transactions, we'd say, take a share purchase takes typically at least 6 weeks from heads of terms being signed to signing of the SPA. But that's very much the bottom end. They can take much longer, and you can have split exchange completions with a gap for example, a regulatory approval, and things can become very protracted. And delay can, if why you're selling is because you want to take advantage of an immediate opportunity, it may be that delay means that you don't have that opportunity anymore, and so that causes the deal to fall over. But also, the longer a deal goes on, the more time there is something else to go wrong. So I know I was advising on a couple of leisure business sales, a year and a half ago or 2 years ago, and COVID came about, and no one could see it coming, and no one's to blame for not predicting a global pandemic. But the longer a deal goes on, the more chance there is of an unexpected factor coming up, which means that the deal falls over. So, remain focused, try and get the deal done as soon as possible, and have everyone pulling in the right direction. And then the final one here is loss of management focus. So a business is likely to be successful because of the work of its owners. And as they're the ones selling, they're going to have to be engaged in the sale process. So this could have a material impact on the profitability of the business. And so, one, if you're a seller, it's important that you try and sort of manage the expectations of the seller. So maybe you're able to pin the purchase price to earnings before the transaction began, because you're aware that it's going to take that hit. And also, it sort of goes back to what I was talking about reducing dependence on the managers. So this can be a way that you sort of look to do that early on by delegating responsibility. It will allow the managers to focus more on the sale, with knowing that they're going to be distracted slightly during the process. And sort of a whistle-stop tour, there's any number of reasons why deals can go wrong, but it's worth saying that our experience is that they fairly rarely do go wrong. Once you're past the heads of term stage, the vast majority of deals do go to completion. But thinking about these issues and trying to get ahead of them early will lower the chance of something going wrong, and hopefully make it a smoother and less painful process for everyone involved.
Yeah, I think there's some questions, and sorry, just going back. Just going back to your question, Max, about is it on the relief, is it on the gain? Meaning that if you bought a company, obviously for £1 million and then sold it for £1.5 million, you'd only be paying tax on the £500,000 gain. So just to be clear about that, I think we deal so often with people who've started their own business that we always assume their base price is nil, but that's not always the case. If you bought the company from someone else, then you're only ever going to pay tax on the gain.
Mm-hmm. So the question from Julie Greenwood is, do we have advice in relation to due diligence to a UK manufacturing business which is selling to a foreign buyer who cannot physically attend the seller's business due to COVID restrictions? Topical and slightly tricky. I mean, I've seen something I was working on over COVID where they essentially had to engage, a cross-border deal as well, where they had to engage local advisors to go in and sort of do the technical due diligence of actually looking at, it wasn't in this case, but let's say in relation to a manufacturing business, plant and machinery, it's going to be important that that's all sort of in working order, and difficult with COVID restrictions. I say avoid delay. From a buyer's perspective, it may be that they won't complete a deal until they're actually able to go out and see an asset. I know that Helen and I have been working on a deal where the buyer wanted to be able to meet with the seller's team, and so things were held up because they just weren't able to do that because of COVID restrictions. But ultimately, it's about the solution, I suppose, is being able to engage advisors who you trust, who can go in and do that for you, or hopefully we're heading in the right direction, at least in this country, heading in the right direction. So maybe there'll be more of an opportunity to go in and do that sort of in-person due diligence in the near future.
Yeah. Agreed. I mean, there's only so far that webinars like this can go, but hopefully there is a case of just taking a phone and walking around a site with getting a video of it, but ultimately it's how comfortable people feel taking that risk. And yes, we have seen one deal that was stalled as a consequence of that, of somebody not feeling comfortable about buying something they hadn't actually seen.
Okay, we've got a question, how to choose the right M&A company. So I take it that means sort of a broker, so someone who looks to, on behalf of a seller, tries to look and find a buyer for them. And I suppose, horses for courses, really. There are some brokers that work particularly in certain sectors. So if you're an early stage tech company, there's any number of brokers who, if you're running an early stage tech company, you've probably heard from lots of them every single month. They're always trying to do their marketing. And there are some who take a more active role. They sort of try and help you earlier in an earlier stage, and try and prepare you for sale. Some who will just come in and say, this is what you have, I will go out and try and sell it for you. So I'd say it's about just having that discussion with as many possible brokers as you can, until it might be a slightly long and painful process, but it's important.
Well, it's the same with coming back to the selling the house analogy. You would probably get more than one estate agent to come around and value the house, and the same with talking to brokers. It's talking to several people and getting the sense of who you've got the right fit with.
Yeah, we partner with a brokerage called Danescore, who have an online platform where sellers can look at buyer, and buyers can look at sellers as well, and sort of you can see who's in the market to buy the sort of business you might be selling. And as a buyer, you can see what companies are looking to sell their business. And that's a slightly more impersonal but potentially more efficient way of doing things. So again, it's horses for courses, I think, is the answer.
Did anyone have any other questions? I don't think so. Well, sorry, we've overrun slightly, but there's so much to talk about. It's such an interesting area, and hopefully it's given you some ideas, and do come back to us individually if you've got any questions.
Yes. Oh, and I've just seen a request for that formula in the chat at the end, which I'll put in there. So yeah, thanks everyone for joining.
Thank you.